Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions.
Everyone talks about Dividend Aristocrats, but did you know there's actually 5 other illustrious titles? And the Aristocrats only fall in the middle? Today you'll learn about each category, like how many years of dividend growth it takes to earn that credo. You're going to want to tune in, because this is another way to find great stocks for your portfolio that are by definition less risky. Fasten your seatbelts. We're ready for takeoff.
Oh, we're back. We're back.
What are you doing?
I don't know.
All right, so today I think is the long-awaited episode for the Aristocrats, Achievers, Dividend, whatever the heck. What is the list actually called?
I don't know. It's just dividend. They have a Dividend Aristocrats is what everyone knows. But
Yeah.
I like the Aristocrats are...
Just one piece of the different categories that
They're
exist.
nice.
Dividend
because
categories?
They're nice.
Classifications?
But, well, there's the Dividend Aristocrats, but there's other ones that have the same, when we get into it, you'll see that there's other ones that have just as much years of growth as the Aristocrats, but the Aristocrats get all the pub.
Yeah, they do get all the pub. So there's apparently, how many categories are there?
I have 1, 2, 3, 4, 5. 5 categories.
Are you going to do the count?
No, because I have to remind them that we talked about economic moats last week. And economic moats are super duper important. And every one of these has a moat of some sort. That's how they have their dividends. They might not be like a wide moat, but they have some sort of moat to raise their dividends for X amount of years for so long.
Okay, I would call these dividend categories for dividend increases, because that's essentially what they're based on, right?
Yeah, that's how
dividend increasing.
Yeah, but then they have other stupid things that go in with them. But yeah, it's mainly how many years they raise their dividends.
Okay. So this is super important.
What you'll encounter whenever, I know, there's Coke, for example, is one of everyone's favorite. And what Coke does to keep their streak alive is they'll raise their dividend 1 cent. That's trash, if you ask me.
Sneaky.
I don't like when they do that, but a lot of these particular companies do that.
I mean, it makes sense to stay in that category, because if you miss 1 year, you have to, it's a rolling 50 or rolling 25, right?
Well, I think the last one I remember was Walgreens it slashed its dividend and its stock tanked. So I guess there's a reason why they do the 1 cent thing, because rather than not have a dividend increase and risk your overall, market cap going down a lot because everyone's like, oh my God, there's problems in the company. And Walgreens is
not a great company.
It wasn't. And I don't even know how they were dividend. I think they were Aristocrat. I don't even know how they had that many years of dividend increases. They're a crap company. They maybe back in the 80s they were cool, but we're talking, I don't even know where a Walgreens is at.
There's one in Dover. That's literally the only one I know exists in the area. And it's we're in a pretty populated region in the Northeast. So
Walgreens at one point had a moat. They were one of the only companies that had stores that did pharmacies. And then CVS came in and picked away at it. And Rite Aid came in and picked away at it. So their moat shrank and shrank and shrank. And then and CVS and Rite Aid were cheaper than Walgreens and in better locations. And Walgreens just got squashed. So
that goes back to the
location.
Oh, I wasn't going to say that. I was going to say the long-term moat. We said that was one of the criteria last week's episode.
Well, what I want you to take away from this, we're going to go over quick, the different categories, and then I'm going to give a couple examples in each one. But what I want you to take away from this is when I give you, say, a Dividend Aristocrat, think of the moat they have, and then apply that to your research for whatever.
Yeah, if you use the two in conjunction, you'll know whether it's a BS.
That's why we did these in tandem, because they kind of go hand in hand, because each of these that I bring up, you should be able to determine a moat. And I'll mention what the moat is. But I think this is an easier way to get started in your portfolio. You can nab a couple of these undervalued ones that have a decent dividend that grow their dividend every year. But then I want you to actually be able to take the moat and do your own research, come up with your own ideas. And then have ARLP, for example. I don't know any other company that has coal associated with their thing. And it gives, I think it's 15% yield. It's the only coal company I know. There might be another one, but it's one of 2 or 3. So that's a moat in itself. There's only 3 companies that's on the stock exchange that sell coal. Same with like the shipping ones. Like if you can find a good shipping one that has good profit margin and good dividend growth and good revenue and stuff like that, that's a pretty good one because there's only like, I don't know, 10 shipping companies.
All right. So let's get back to the point before we rehash too much of last week's.
Oh, okay. So the first one is a Dividend Achiever. There's about 400 total. So the moat's quite narrow in these guys.
Achiever sounds so lame.
Yeah.
It's like the achievement awards for last place, or like, what is it? Those ribbons for every place in the thing.
Everybody wins or whatever. Yeah. They've only raised their dividend at least 10 years in a row. Other criteria is they must be listed on the New York Stock Exchange or the NASDAQ exchange, and they have to have a 3-month average daily trading volume of $1 million. So there's a couple criteria that go along with it. It can't just raise their dividend 10 years in a row. You have to have numbers. The second one is Dividend Contenders. I should preface that you can be in
multiple categories. I think you said that earlier, but
Dividend Contenders, there's 340 about. I think there's 340 exactly total. They've raised their dividends over 10 years in a row, but less than 25 years in a row, and they don't have that other crap that goes with it where they have to be listed on the stock exchange or have any monthly averages.
Yeah, so the only criteria for that one is between 10 years and 25 years of dividend increases.
The one that everybody knows, everybody that invests anyways, there might be people that don't know, but is Dividend Aristocrats. There's 68 total. They've raised their dividends 25 plus years. They have to have a minimum market capitalization of $3 billion for some reason. I don't know why. I guess that's just a criteria that they came up with to make the list cool.
That's interesting.
They must have a 3-month average daily trading volume of $5 million. I don't know why because how they come up with these.
I know, because they don't have criteria for the next two. It's kind of weird.
Arbitrary things. I don't know. And then you got Dividend Champion, which is the same as Dividend Aristocrat, but it doesn't have the other crap with it. It's Dividend Champions.
There's no market cap.
Raise their dividends 25 plus years, and that takes the total from 68 Dividend Aristocrats to 150 Dividend Champions.
Well, to me, that looks like the two categories of Aristocrat and Champion should literally just be combined, and the whole minimum capitalization and the daily trading volume should be out the window. Like, what is that? Why? That's stupid.
I guess so.
And that's a heck of a gap between this one and the next one. So the last category
is Dividend Kings, and they are only 50, and they've raised their dividend 50 plus years.
So they go from 25 years to 50 years.
I don't know what...
That's a heck of a gap.
I guess.
I imagine there's people in between
most of the time, they hang out in this one for a while.
Yeah.
And then they eventually roll over to a Dividend King. They hang out in the Aristocrat area, and then they roll over to a King after some point. I guess it makes them feel good.
I would imagine if you like the small caps like you do, you're looking for champions. Champion.
It's very difficult to find small cap because of these stupid...
Well, that's what I mean. They won't be labeled as aristocrats. They'd be labeled as champions, if anything. All right, so
like I said, you can be in more than one list. For prime example is Triple M. It's both a Dividend Champion and a Dividend King.
Yeah, we got a hard on for this company lately.
They just did a spinoff today, so I don't know what the hell is going on with the share price, to be honest. They spun off their, I think their pharma into something, so they got rid of that.
Triple M has pharma?
Yeah.
Interesting.
Okay, so I'm going to give you a couple of each category here. Dividend Kings is Triple M.
Wow, that one's actually a king.
It's currently trading around, I think it's 95. I just looked, but when I did this, it was trading at 92, and its fair market value is 162, so it's vastly undervalued. Currently yields 6.6 and has raised its dividends 66 consecutive years.
That's incredible.
So that's one to possibly, like, I got into that as soon as I saw it drop down to like 90.
Now I can see why you have such a hard on for Triple M. I mean, I was just looking at it from a product standpoint. But that's fantastic.
They have everything.
Yeah.
Another Dividend King is MO, Alteria. It's currently around 40-ish, and it has a fair market value of 73. It yields 9.9 and has raised its dividend 55 consecutive years. So, like, way to start a good portfolio for income. Like, literally, if you put those two together, that's, what is that, about 8.2, 8.3% just between the two of those.
And you're getting Dividend Kings, which are paying pretty good. They're more than a lot of the aristocrat, like the big market cap trendy ones.
And then we got a little sissy one here, ADM. It's currently around 53, has a fair market value of 100. It yields 3.7. EU, and has raised its dividend 50 consecutive years.
Okay, so those are the three biggest.
Like, well, that's what you like when you look these up. They'll be like 1.2, 0.8. So even if they're raising their dividend every year, their yield's only 0.8. It's trash to me. Like if you're looking for income, that's nothing.
Interesting. Okay. I imagine Coke fell in this category.
Coke is a dividend king, but their yield's only like 3 point something. Other.
So that's why Coke is not on the list here, in case you were wondering.
Okay, dividend champions. To prove that I'm not full of crap. Triple M's a dividend champion as well. So everything I said about Triple M a couple minutes ago, rehash.
Well, it's like the quadrilateral example that I like to use. Or probably for people who aren't math geeks like I am, the square versus rectangle example. All squares are rectangles, but not all rectangles are squares. So they carry down. Oh my God. Sorry.
Very interesting.
Shut up, Tim.
ES is currently about 59, has a fair market value of 90. It yields 4.9 and has raised its dividend 25 years exactly.
Which one?
ES.
What the heck is ES?
It's a energy company.
Ah, okay.
And ALB, which is a lithium something other, its dividend is crap, but it's like super undervalued. It's currently like 118 and has a fair market value of 270.
That's less than 50%.
Like I said, it only yields 1.1, so that's trash, but it's raised its dividend 28 consecutive years. The reason I put that on the list is because you're going to get a lot of price appreciation if lithium keeps being a big thing, which I think it will. Yeah,
because the whole EV thing, because that's what they use for the lithium-ion batteries that are basically going in everything. I mean, even the little Dookie headlamps that we use are going lithium battery. Mm-hmm. All your phones are lithium battery. I imagine the tablets and computers and whatnot have lithium crap in them.
So there's a couple of ideas where I like my sweet spot is not. We're not my sweet spot yet, but Dividend Aristocrats, everybody's favorite category. I hate it, but okay. O is everybody's favorite dividend aristocrat.
That's so funny.
Everybody loves that company for some reason. I don't know why. Currently 52.50, fair market value of 90. It yields 5.9, and it has raised its dividend for 31 consecutive years. It's a way to get, I guess, a good REIT if you like O, what they do. I don't.
Why do you not like O? Because that's got a almost 6% yield, and it's undervalued.
There's other ones that do the same thing.
That are better?
That give you more yield.
Okay.
Like, I'm looking for income. Like, well, when we get down to contenders, you'll see, like, the one I'm in, the REIT that I'm in is awesome, and it's undervalued, and it yields more. It just hasn't raised its dividend in many years. Chevron, CVX, is currently 149 and has a fair market value of 200, so a little bit of appreciation there. It yields 4% and has raised its dividend 37 consecutive years. Leg, I don't know what the hell that is.
I want to say Lego, but I know that's not right.
No, it's like a Leg and Pratt or something like that. It's like I think it's like a infrastructure stock, but I don't know why it's called Leg.
I mean, that has a fairly decent yield.
It's currently $20.50, has a fair market value of 45. It yields 8.9% and has raised its dividend 53 consecutive years. So it's almost.
Yeah, I was actually wondering why this one has never come up before. I'm imagining.
Almost a king, right? It is a king. I could have put that in the king category. My bad.
Okay, so there's a king with a pretty high yield.
There's a king and aristocrat. But the problem with that one is like the share price has been depreciating for like the last 5 years or so.
Okay. I was gonna say I figured your research would have ruled this one out for some reason.
Because I do like infrastructure stocks, but like they never pay anything. So if that's what it is, I honestly.
I think you should actually look into that one just out of curiosity.
Okay. Pause. Leg stock. Leggett and Platt. Diversified American manufacturer that designs and produces various engineered components and products that can be found in homes and automobiles.
Zoom out on that chart. I want to see this. Oh, yeah. Looks like a penny stock chart.
That's what I'm saying. Like it's
like trending to zero. What is happening?
Like after COVID, it shot up like everything did. But then after before 2022 even happened, when it was the time, it started going down. And it's just been going down ever since 2021.
All right. So my guess is that met every other criteria except probably long-term chart happiness.
So it's down 60% in the last 5 years.
That's pretty crazy. Something has to be going on.
But
I imagine you could tell by reading the quarterlies, but to us, I guess there's no point.
I do like the diversified manufacturer that deals with homes and automobiles, but I don't like it enough to own it. So that's you. Do your research on it. And anything I mentioned, honestly, do your research. because, like I've said it before, no one cares about your money and your situation more than you do. Like, I want you to genuinely do well, but like, I don't care as much as you do. Just
about
truth.
your portfolio, your particular needs, your particular values, and everything.
I'm being honest. Okay, so now let's get down to contenders. Like, here's where I shop at. The contenders.
Here's where I shop at.
The
Store contender.
The contenders and the achievers is where I hang out. Yeah, I do that with my van and go, hey, little girl, you want some candy? Yes.
Rolling up to the contender neighborhood.
Contenders.
Oh my God, that's so funny.
Arbor, ABR, currently $12.50-ish, fair market value of 45. It yields 13.25 and has raised its dividend 10 consecutive years. So like, see what I'm saying? Like it has a decent dividend increase year streak going on. It yields 13.25. So I'd rather be in this REIT than, I'm making twice as much, a little more than twice as much. And I'm paying a lot less for what I think is more price appreciation. I didn't do the math, but 90 is that's like 40 some percent. And that's like more than 40 some percent.
Yeah.
NAP, which I beat the table on. I don't know if anyone listened. I hope you did. It's the alternative energy for NE in Florida. Is currently $28.50. Has a fair market value of 75. It yields 12.15%, and it's raised its dividend 10 consecutive years as well. And I know I beat the table on the next one, Verizon.
Verizon isn't actually an aristocrat.
Not yet. It will be soon.
Oh, all right. Somehow. Is AT&T in the aristocrat category?
I have no idea. I don't care because AT&T's trash, so I don't even look at it beyond that.
Oh, okay. Good to know.
I mean, I'm sure people like AT&T. I just think it's trash. Verizon's currently $40 around there, has a fair market value of 51, so not a lot of price appreciation, but it yields 6.6% and has raised its dividend 19 consecutive years.
However, had you listened to us before, you would have got in at a better price point.
Yeah, I got that for like 28, something like that.
Yeah, that's pretty crazy. That's like almost 50% below market value.
So, I don't know, like when I beat the table on something, I don't normally.
I was going to say, there's a reason Tim beats the table on things. I don't normally beat
on the table for anything, but like when I do like NEP, ABR, and Verizon, I've all mentioned numerous times.
But I think we did an example of one where you gained like a price appreciation of like 30% in a matter of like, I think less than a month.
It was NEP. I got NEP at like.
But I think Verizon did something similar. But anyway.
I got NEP at like 18. And it shot right up as soon as I bought it. And then Trinity did the same exact thing. We got it and it shot right up.
We would have probably done the same thing with IEP had we saw that happen before we were actually in it.
Icon. I don't know what I'm doing with that. Like, I like what he's doing, but anyway. His company.
That's a whole side problem.
Now we have the Achievers. If you recall, Achievers have to be between 10 and 25 years, I think.
Yep, 10 and 25.
Pfizer.
Yeah. No. Contenders is between 10 and 25, and Achievers is... Achiever and a contender are the same thing.
Well, that one has those other criteria with it.
Okay, so it's the same BS. Okay.
Same nonsense with the member. So, okay, my Achievers, I hang out down here a lot.
Okay, so the difference between Achievers and Contenders is the same thing like Aristocrats, and Achievers have the extra market cap requirements where the Contenders do not.
Yeah, well, it doesn't really matter.
I feel like there should be 3 buckets.
Look, I don't care about...
Yeah. If we're literally just looking at this, we only particularly care about this from a number of year increase.
I want a company that's raised its dividend, that has good financials, blah, blah, blah. Pfizer. I got her mom into it. I don't know if I'll ever get into it, but...
I think it's because it had a big dip, right? You were like, snagging that one.
Yeah, I got it for dirt cheap. Currently is 26, has a fair market value of 30. It yields 6.3 and has raised its dividend 14 consecutive years. So, decent. I mean, like I said, BMY is better. So, it has a less dividend, but it has, and you'll see, BMY, which is another pharmaceutical, is currently 50, has a fair market value of 80, so more price appreciation. It yields 4.7, so it yields less than Pfizer, and it's raised its dividend 15 years. I like BMY better than PFE. That's just me. CTO is I want to say it's like a BDC, but CTO is a REIT. My bad. Not a BDC. REIT. Currently is 17, has a fair market value of 20. It yields 8.8 and has raised its dividend for 12 consecutive years. So that's pretty decent for a REIT. EPD, which is like everybody's that invests in oil has heard of it.
Yeah, I'm not familiar with that one.
It's like one of the better ones. It's currently $27.50 and has a fair market value of 31. It yields 7.25 and has raised its dividend for 27 consecutive years. So
27, isn't that above the 25 threshold?
it doesn't meet the other criteria, I think.
Okay.
So what you can do with these examples here, right, is you can pick and choose, create like a core portfolio that mitigates a lot of your risk, so that then you can dump money into other high yielders like Icon or ECC, knowing that majority of your money is tied up in stuff that's pretty conservative. Like, these are all pretty conservative. I mean, there's going to be price fluctuation, obviously, like
anything
any
else
stock, but for the most part, these are pretty safe investments. And that, how I constructed the retirement account for her mother is I have a lot of Contenders, Achievers, Kings, whatever, and then I sprinkle in like Hercules Capital, which I think's a year away from being a contender. I want to say 10 years. I think it's at 9 years. Hercules is another one that will soon be a contender. And I sprinkle in Hercules, and I sprinkle in I did Icon. I have other higher risking ones, but they only take up like
a smaller percent of the portfolio.
Say like less than 20% of her portfolios in riskier assets.
But you mitigate some of that risk even in itself with the better price point of entry, correct?
Yeah. So like what I've learned, okay, like if you've subscribed to the email, you'll notice that it changed like midway through the year last year. What I learned is getting something that's undervalued is more important than getting something that yields 10% or more. You can still find the 10% yielders, but the more important data point is the entry price.
Yep. And that's what happened with IEP.
So that's why if you've listened for a while, you've seen how we talking about bullet shares. The bullet shares came about because I needed money in cash form so that I could dump it into other stuff once I determined that the super important part of the contrarian investing is actually value investing. That's how we came up with the contrarian value investing income.
And he found the bullet shares because he doesn't like to have idle money. I know he doesn't like to have idle money because he's always like, I need to put this money into something. Your
money should always be making money. Like, your cash should always be making cash. That's like all the rich people do it.
I know. It's absolutely true.
That's the reason why they do it.
And bullet shares are freaking golden.
They don't really move too far from the
datum point,
the point that you buy them at. But like, if you've been listening for a while, or you subscribed to the email for a while, you saw that I actually changed it about, I want to say like halfway through when we started doing this, and that was why. Like, I determined that getting into something at a good value price. That's why the top 10 high yielding things was replaced by the top 10 things that I think are the best value going forward every week. Is because what I'm giving you is all of the information that you need. Okay, this is undervalued. This is undervalued. So you're getting like 10 ideas that are all undervalued that have a yield that's pretty good that you then do your own research with. With those coupled, then you should couple those with some of these aristocrats and contenders and achievers. Even these I'm giving you here, like there's obviously there's hundreds of them, but I gave you the ones that are undervalued.
Yeah, and the best options for you.
Because we're in a bull market, you have to like actually find stuff that's undervalued. You can get into anything, but if you get in at the wrong price, which is what we did with Icon, and for a while it was awesome. We got in at, I want to say $54, and it was up at like $88, and it was awesome, but 54 was still too much. I should have waited to get into that till after a bad earnings report or something like that. Like, if I determined that I wanted to get into it, I should have waited for a bad earnings report where it dropped like 15-20%. Down into the 30s, which it did a couple times. I should have got it in the 30s, because even if it's at 17 and I got it in the 30s, we'd be up in it because the dividend covers the difference.
Yeah. Didn't you just reassess the portfolio? You said all of our losses from Icon, which is huge.
We're up in pretty much everything except Icon. MPW and the Tesla Yield Max.
We're break-even value-wise, right?
Break-even value-wise because of MPW. MPW, we're down 40-some% with dividends. Icon, if we didn't have the dividends, we'd be down like 60%, but we're only down like 30% in Icon with the dividends reinvested. And the Tesla ones, like, that was just a mistake. I shouldn't have done that.
Is it because we had a heavy allotment in that? Because we found the yield maxes pretty early and they didn't have a ton of options at that point?
Is that what happened? No, I like Tesla. I want to make money off Tesla, but like the person running it's trash. They're like, if you look at the yield maxes, we're in 5 different yield maxes in our portfolio.
So we just had the bad luck of the one.
And like all the other four are doing awesome. The Nvidia one's doing remarkably well. The Coinbase one's doing remarkably well. The Amazon one's doing good. The Microsoft one's doing good. Tesla, for whatever reason, like whoever's running it, they're doing their call options wrong or something.
Yeah. And we're curious to see what happens with that because they just did a reverse stock split.
They did a reverse stock split like a month or two ago.
Yeah. So
and it wreaked havoc and everything. So I won't even know like how far down we actually are in it because I had to delete everything because like it just f***ed everything up.
So I don't know what that's going to present, but basically there's so many other yield max options. Don't risk the Tesla one right now.
I know because I saw on an Instagram that people are like touting this whole like I put $10,000 into Tesla. Look at my dividends. What they're not telling you is the $10,000 they've probably lost like half of it in depreciation. So even if the dividend, but it's not even the best dividend. The best dividends like they change from time to time based on the macro trends. Like Nvidia's super hot right now, so Nvidia's
he's so hot right now.
Nvidia's dividend is kicking ass, and then Coinbase, because the Bitcoin halving is super fire right now, and like its dividend is way high. I found with those the first like 6 months the dividend's super high, and then they start to level out to what they're going to be. So I guess they're trying to entice people to come in.
That makes sense.
And they give you like a ridiculous high dividend.
What's nice though is if you do that one that's the average of the yield max,
if you do the Y max, it's everything. And anytime they have a new one,
it gets automatically incorporated.
Yeah, automatically.
So that one's kind of like a what are they called? An index fund of the yield max.
It's an index fund of the yield max. So like that's, but like back to my point, like I got into the Tesla one at the wrong price. I should have waited until I don't know, like it was a better value. But those are very difficult to value.
Live and learn. Yeah, they were super new and we were trial and error.
They're very difficult to value because they start at 20 and anything under 20 you would think would be a good value, but it's not. Like the ExxonMobil one's like a good value for the ExxonMobil is like under 16. A good value for the Tesla one's like under 15. So I was like, oh, I got it for 18. Awesome. I got it for $2 under par. And it just shot down. So don't put a lot of money in that. We only have like, I want to say 3% in Tesla.
We've warned before about putting like between 1% and 5% of your portfolio in the yield max, and they are higher risk.
But you can, if you want to have like, I've read a lot of things where you should, like a lot of people really live by the 12 to 16 stock thing because it helps. It's easier for people to navigate. You can put like 8 to 10%, say, into Triple M or into IIPR, stuff like that, that you know is a really good company and that they'll be around because they have a big moat. Like, and Triple M's moat is huge. Pfizer's moat is huge. They're like, because that goes back to the one we were discussing with the patents. Yep. Because they have patents for freaking everything that haven't expired. So Pfizer's moat's huge. Bristol Myers Squibb's moat's huge. Triple M's moat is huge because they have all these different patents that don't expire for X amount of years. ABR's moat's not so big because it's just it's a REIT that does like multifamily. There's a lot of REITs out there that do multifamily.
But I think they have a little bit of a, what do they call that? The blue ocean or the standout effect because they plant trees. People are starting to get into philanthropic component.
But if it has a big moat, you can get in with a higher valuation because you know that the moat's going to take care of any problems with price. ABR is trading so well below its fair market value that the narrow moat shouldn't be a problem because you're still there's a lot of room for price appreciation. NEP is like the darling because it literally has an economic moat. It's the only...
Because it's a utility, right?
It's the only alternative energy in Florida. And it's part of NE, which is the only like electrical company in Florida. So you're getting like a big moat in a big state that's population is growing for something that is like 50% undervalued. That one should be a no-brainer.
Well, and what you were just saying with the percent of the portfolio and the, what did you say, 16 stocks that they recommend, I think that's personal preference. We personally like to have more stocks to hedge risk with something like Icon, because had we had a higher percent of the portfolio and something like that, we would be down a significant amount. Another
one with a huge moat is MO. I'm going through like trying to help people. MO's moat is ginormous. There's only like 3 cigarette companies: MO, BTI, and PM.
And even if you're against this, like
if you're a smoker, But
brand
if
loyalty
you
out
know
the
smokers, you know they like one brand. So MO, which I believe is like Camel and Newport and all that crap. I don't know which ones they have, but like.
And I kind of feel like the people that are still smoking are going to smoke indefinitely.
So you're getting a company with a huge moat for like 40% undervalued that yields 10%. Like, I'm hoping this is making sense how you can use the moats with the undervalued to get huge price appreciations with good dividend yield plus dividend growth. That's what these two things were about.
I was going to say, so basically what I've gathered from these last two episodes is you start with these categories and then you look at whether or not they have a moat at all, narrow or wide. And then
moat.
Mully.
One wide. If you can find wide, awesome.
Wide gap moat. And then if you get those are the ones that you should start investing in. But you definitely want to find the ones that are undervalued. So I guess it's a trifecta where you find the category, then you look for the moat, or I guess maybe you start with the undervalued.
Well, I can tell you right now because of how things are going, like REITs, undervalued. Utilities, undervalued. Mining, like gold mining stocks are pretty well undervalued compared to the price of gold.
And I don't know if we actually mentioned this on the podcast yet. I think this was just a sideline conversation with Tim, that Powell has officially announced that they're planning to decrease interest rates 3 times this year.
At least 3 times this year.
At least 3 times this year. So
stock up on REITs.
Stock up on REITs.
Because they're going up. Stock up on utilities because they're going up.
The housing market's probably going to pop off, which is crazy.
But like that's what we discussed the macro trends. And you have to be aware of the macro trends. That's like probably 25% of investing is having the ability to look beyond like next week and see what is going on. Like Triple M, the reason I got into Triple M is because they had a lot of lawsuits. The price was hammered because of the lawsuits. But I saw they hit a huge moat. They have a patent for like 200,000 different things they sell. They've raised their dividend for 66 consecutive years. It's over 6%. To me, a no-brainer. You're getting, 40%, 50% price appreciation. While you're waiting for the price to appreciate 50%, you're collecting 6.6 at the very minimum yield, and you're going to get dividend increases every year. I mean, it's a no-brainer.
Absolutely.
I hope it helps people because I'm making it sound simple because it is.
No, it really is. It really is. These other people that make it so complicated are the
ones that like I have a lot of subscriptions where like they go into all the technical jargon and they're like it's so much work to do all this technical work, so you should probably just pay me like $200 for the year and I'll tell you everything to do. I don't like people like that. I actually despise people like that. I've written emails to them saying that's just nonsense. It's simple.
Have they replied to you?
Oh no, they haven't. It is a complex thing, investing, but it actually is simple.
I think it's simple. You just have to put in the work and do your due diligence, basically.
And that's where I'm trying to help.
And stay disciplined. I think the emotional factor is probably the bigger monkey wrench.
So like if you see everything we've done, like the last 2 months is leading up to how simple it actually is. You take emotion out of it with the psychological biases. You take all that crap out. You're just looking at data. Then you actually apply it to the moats and you apply it to the valuation. You apply it to dividend growth. Dude, I've made it simple.
Well, essentially what I'm taking away from the whole thing is that like investing actually is very simple. You come up with which type of investing you'd like to do, which is exactly what we did. You got your goals, you got your whatever. Like you are the hardest part. Like knowing yourself is the hardest part, knowing what you want to do. And then you just align things and you fit the other stuff in. Like the investing part is actually very, very simple. It's like, I think the hardest part is the human behavior component.
Well, the hardest part is there's 19,000 stocks. So the screener is super huge.
And the screener piece, having your actual metrics to narrow down your pool.
But I gave them that to make it simple.
Yep.
Like they literally can start with a list of 300 instead of 19,000. And then they can go through and they can look for moats on that list of 300.
Yep.
Then they can look for Dividend Kings, Dividend Aristocrats.
So the rest of these episodes are just ways to actually narrow that pool down so that you actually know you're getting into good companies and you feel confident in what you're doing. So hopefully the emotional potential to make irrational decisions is less of a problem.
It is.
That's
what I got. The reason that I haven't done the brokerage podcast yet is because I don't know how to be fair to everything else besides Schwab. Because Schwab, I'm telling you.
Well, maybe I'll take the lead on that episode then, because Tim is so biased.
You go into Schwab, you type in the search bar whatever you're looking for, and say you want to do more research on MO. You type MO in the search bar. It literally will bring up all the information you need, and at the bottom, it literally has their dividend yield. Then it has, like, you can click on the history. So it'll give you the history of the dividend. Below that, it has the PE, and then below that, it has like the price valuation, like the PE of its competitors. It has the revenue, it has the debt, it has all that. Then you can click on, and you can see. Then you can go into it, like the actual tab of. It would be tobacco. So you click on the tobacco underneath MO, and it pulls up all the tobacco stocks with their valuations all lined up. It gives you the average of all the tobacco stocks. So you can tell that MO is undervalued.
The average PE of the competitors or the industry.
All the competitors in tobacco. It is by far, like, I've been in Vanguard. I've been in TD Ameritrade.
TD Ameritrade's merging into Schwab, so I'm not sure that one even matters anymore.
I've been in Robinhood. Absolute. Like, I don't know how to be fair.
We've been in E-Trade. We've been in Scottrade. We've been in...
I don't know how to be fair to the other brokerages. That's why it's very difficult for me, because I don't want to just give a biased piece about how Schwab is.
I really do think Fidelity is the only one, and maybe some of these odd off ones.
Because Schwab literally brings up everything that you need to make sure you're getting something undervalued.
100%. All right, so next week we are going to talk about tech resistance.
I did a 2-part email about tech resistance. Is the first part, how everyone's they're resisting cryptocurrency and blockchain because whatever. I think they don't understand it. They think cryptocurrency is literally tokens, and it's not. It's networks and programs, and so you're...
Well, and I think it'll be a little interesting, too, because we were talking about different generations having resistance to different things, and we were even evaluating ourselves, because Tim is a Gen X, and I'm a millennial, and it is kind of interesting to think about what resistance points are potentially going to come up for us. So that's actually going to be a really interesting episode.
Mine's TikTok.
But it's not just that.
I hate TikTok.
No, we were talking about the EV component.
EV, I'll never drive an EV because I like to drive.
But that's what I'm saying. So it's like, that's going to be a really interesting episode. So hopefully you got some key takeaways for these.
It gave you a whole load of ideas.
What is this? Like we keep saying dividend growth categories.
Yeah, we put this off for a while, but I had a plan. I wanted to make everything up to this make sense so that whenever you see these, it's easier for you to just say, that's a good one, that's a bad one, because you have all the tools in your arsenal now.
It's one of those things. Tim doesn't know why his brain does what it does, but in the end, it
is beautiful.
There's a method to the madness.
So pretty that, like, you know everything now. I don't need to do anything. So what am I going to talk about?
Which is good, because then we can just update you on market trends, if we're moving in and out of things, if news comes out and something hits. Like, I'm actually excited to get to the points where we're talking about.
I literally just sold all my position in SLRC.
I think we should do a different episode on that. Let's wrap up.
Okay. Just ignore that. I didn't say that. All right.
So thanks for tuning in, guys. I hope you enjoyed the episode.
Next week is
tech resistance.
Because tech goes with cryptocurrency, and cryptocurrency has a halving coming up in a couple weeks. And then it's going to take off to the moon for like 8 months, and then you should sell everything.
Spoiler alert. See you next time.